Hello friends. Welcome to our channel SNK Company. Let us start with this week's important updates under the Income-tax Act, GST law and other related legal developments. In today's update, we will discuss some important judgments which have significant implications for taxpayers, businesses and professionals. Let us begin with the Income-tax Act. The first important development is from the Supreme Court of India in the case of Surinder Sablok versus Deputy Commissioner of Income Tax. The case concerns prosecution under Section 276cc of the Income-tax Act, which deals with failure to furnish the return of income within the prescribed time. The assessee had contended that the revenue was required to establish the necessary mens rea before initiating or continuing prosecution. The Supreme Court granted special leave petition against the order of the High Court. An important aspect of this case is Section 278E of the Income-tax Act, which provides for a statutory presumption regarding culpable mental state in proceedings for specified offences. Therefore, once the statutory presumption applies, the burden shifts upon the accused to prove the absence of the required mental state. The important point for taxpayers is that prosecution under Section 276cc is not merely a routine consequence of an income tax assessment. Failure to furnish a return within the prescribed time can have penal consequences, and Section 278E can significantly affect the burden of proof in such proceedings. The next important decision is from the Madhya Pradesh High Court in the case of Principal Commissioner of Income Tax versus Aditya Agrawal. In this case, the assessing officer treated the assessee's exempt long-term capital gains from shares of Safal Herbs Limited as non-genuine penny stock gains and made an addition under Section 68. The assessing officer had primarily relied upon material received from the investigation wing. However, the assessee had produced supporting evidence relating to the transactions, including banking records and demat records. The High Court held that where the assessee has substantiated the purchase and sale transactions through documentary evidence, an addition cannot be sustained merely by relying upon general information received from the investigation wing without conducting an independent inquiry into the assessee's specific transactions. The important principle emerging from the decision is that general allegations concerning manipulation of a particular scrip cannot automatically establish that every transaction undertaken by every investor in that scrip is bogus. The assessing officer has to examine the evidence produced by the assessee and bring specific material on record if the transaction is to be treated as non-genuine. The next decision is from the Indore Tribunal in the case of Lakshmi Narayan versus Income Tax Officer. The assessee was an agriculturist who had purchased agricultural land. The consideration was partly paid through cheque and partly in cash. The assessing officer treated the cash payment as unexplained investment under Section 69. However, after examining the assessee's explanation and the actual calculation of the consideration paid, it was found that the source of the cash payment had been properly explained. The tribunal therefore held that the addition towards unexplained investment could not be sustained. The decision highlights an important principle that an addition under Section 69 cannot be made merely because the assessing officer has doubts regarding the utilization of funds. The revenue has to establish that the investment was actually unexplained after considering the evidence and explanation furnished by the taxpayer. The same Indore Tribunal decision also dealt with the issue of agricultural land and capital gains. The assessee had sold agricultural land which had continuously been used for agricultural purposes and was also described as agricultural land in the sale deed. The tribunal examined the applicable municipal limits and the relevant notification No. So 9447 dated 6 January 1994 for determining the distance of the land from municipal limits under Section 214. The tribunal held that the relevant municipal limits for determining the 8-kilometer distance were required to be considered with reference to the date specified under the relevant notification. Since the land was situated beyond the prescribed distance and continued to retain its agricultural character, it was held that the land was not a capital asset within the meaning of Section 214. Consequently, the capital gains addition, including the addition made by applying Section 50C, was deleted. This decision is particularly relevant in transactions involving agricultural land because the actual use of the land, its classification in revenue records, and its distance from the relevant municipal limits can determine whether the land falls within the definition of a capital asset. The next important decision is from the Raipur Tribunal in the case of Asset vs Maheshwari Coal Beneficiation and Infrastructure Private Limited. The assessee was engaged in coal trading and transportation and had received unsecured loans from 5 companies. The assessing officer made additions under Section 68 treating the loans as unexplained cash credits and also made a consequential disallowance of interest. The loans were subsequently repaid in later years. After considering the facts and supporting evidence, the tribunal held that the addition under Section 68 and the consequential interest disallowance were not warranted. The decision reinforces the importance of examining the complete documentary trail relating to loan transactions, including the identity of the lenders, the financial position of the lenders, the banking trail and subsequent repayment, rather than making an addition merely because the assessing officer has doubts regarding the transaction. Our next important development comes from the Karnataka High Court in the case of Commissioner of Income Tax vs Ananda Social and Education Trust. The assessee was an educational trust which was subjected to search and seizure proceedings. During the search assessment, the assessing officer made additions towards alleged unaccounted capitation fees based upon seized material. The tribunal, however, found that the seized material specifically related only to certain assessment years, namely assessment years 2009 to 10 and 2014 to 15. For the other years, the additions were based essentially on presumption, estimation and extrapolation without sufficient corroborative evidence. The tribunal therefore deleted the additions. When the matter reached the High Court under Section 260A, the High Court held that where the tribunal has arrived at findings of fact after considering the material available on record, and such findings are not perverse, the High Court cannot simply reappreciate the evidence and substitute its own factual conclusions. This decision is important in search assessments because additions based merely on extrapolation from one assessment year to another, without corresponding incriminating or corroborative material, can face serious legal challenges. Another important judgment is from the Bombay High Court in the case of Rajesh Somandas Sachdev vs Income Tax Officer. In this matter, the assessee had failed to furnish the return despite a notice issued under Section 148 and prosecution under Section 276cc was subsequently initiated. However, the assessee later filed the return and the return was accepted in regular assessment. After giving credit for TDS, the assessee was actually found entitled to a refund. Considering these circumstances, the Bombay High Court held that continuation of the prosecution was wholly unwarranted and amounted to an abuse of the process of law. The decision demonstrates that although failure to file a return can result in prosecution proceedings, the subsequent conduct of the taxpayer and the ultimate outcome of the assessment can also become relevant while examining whether continuation of prosecution is justified in a particular case. Now let us move to the important developments under GST law. The first important GST decision is from the Andhra Pradesh High Court. In this case, tax determination proceedings relating to several tax periods were concluded through a single composite assessment order. The High Court held that such a composite assessment order was not permissible under the GST framework. The order was therefore set aside, while the authorities were given liberty to undertake separate proceedings for the respective tax periods after providing the taxpayer an appropriate opportunity of hearing. The decision is important because GST proceedings are structured around specific tax periods and several aspects, including limitation and determination of liability, have to be examined with reference to the relevant period. Therefore, taxpayers receiving a consolidated GST order covering several tax periods should carefully examine whether the statutory procedure has been correctly followed for each individual period. The next decision is from the Rajasthan High Court concerning service of GST demand orders. In this case, the assessee remained unaware of the GST demand order because the order had been uploaded on the GST portal under the section relating to additional notices and orders and had not otherwise come to the taxpayer's attention. By the time the taxpayer became aware of the order, the electronic filing of the appeal was showing the matter as time-barred. The taxpayer therefore approached the High Court seeking relief against the delay. Considering the circumstances, the High Court condoned the delay and directed that the appeal be considered on merits. This decision highlights a very practical issue under GST. Taxpayers should regularly monitor the GST portal and should not rely solely upon emails or other forms of communication for checking whether a notice or order has been issued. At the same time, where genuine circumstances demonstrate that the taxpayer was prevented from filing an appeal within time, appropriate judicial relief may be available depending upon the facts of the case. The next Rajasthan High Court decision concerns GST on affiliation fees paid by a college to a university. GST had been demanded on such affiliation fees. The High Court noted that the issue had already been settled in favor of the taxpayer and that GST could not be imposed on the affiliation fee in the circumstances of the case. Accordingly, the GST demand was set aside. This decision may be particularly relevant for educational institutions because transactions involving affiliation, recognition, and academic or regulatory functions can raise important questions regarding the nature of the service and the applicability of GST exemptions. We now come to a particularly interesting and contemporary GST development from the Gujarat High Court concerning the use of artificial intelligence in tax proceedings. The petitioner challenged GST proceedings on the ground that the state tax officer had relied upon cases identified or generated using artificial intelligence, but some of the cited cases were either non-existent or irrelevant. The matter was considered seriously by the High Court. After the concerned officer tendered an unconditional apology, the impugned orders and consequential proceedings were set aside and a fresh notice was directed to be issued. The authorities were also directed to follow the applicable departmental instruction regarding the use of artificial intelligence. This case carries an important message in the present digital environment. Artificial intelligence can certainly assist in legal research, but AI-generated information cannot substitute for verification of the actual legal authority. Before relying upon a judicial precedent in a show cause notice, assessment order or adjudication order, the authority must ensure that the judgment actually exists, that the citation is correct and that the decision is relevant to the issue under consideration. The same principle applies to taxpayers and professionals using AI for tax research. AI can be a useful research assistant, but the final legal verification of every authority remains essential. So, these were the important income tax and GST developments covered in this week's update. We discussed significant decisions relating to prosecution under Section 276cc, the statutory presumption under Section 278e, penny stock additions under Section 68, unexplained investments under Section 69, agricultural land and capital gains, unsecured loans, search assessments, and the evidentiary burden on the revenue. Under GST law, we discussed composite assessment orders covering multiple periods, limitation and filing of GST appeals, GST on university affiliation fees and, importantly, the proper and responsible use of artificial intelligence in tax administration. If you found this weekly tax and GST update useful, please like the video, share it with your professional colleagues and subscribe to the SNK Company channel for regular updates on income tax, GST and other important developments in tax and corporate laws. Thank you for watching. We will meet again with another important weekly tax and corporate law update.